An uneven recovery, or are we slipping back into recession? We'll check with the experts on the latest economic readings. Plus, will the healthcare debate open up new investment opportunities? It's time for Money Talks America. Welcome to Money Talks America. I'm Snaith, Director of the Institute for Economic Competitiveness in the College of Business Administration at the University of Central Florida. We're tapping into a rich vein of expertise here at the Money Show in Orlando. Hundreds of investors are here at the Gaylord Palms Convention Center to pick the brains of experts, ranging from mutual funds advisors to metal mavens and bond barons. As we lurch through the first few months of 2010, several key indicators and events are unfolding. President Barack Obama has proposed a $3.8 trillion budget for fiscal year 2011. That will add fuel to debate over the size and the scope of government. The plan includes big increases in personal and business taxes, modest spending cuts, and increased outlays for education, defense, and jobs initiatives. But the budget plan calls for nearly $1 trillion in tax increases on upper-income families, largely through allowing the Bush tax cuts to expire. Banks, bankers, and multinational corporations would face new fees and levies, and oil companies would lose $39 billion in tax breaks. There is a record $1.6 trillion gap between the proposed budget outlays and tax receipts. The yin and the yang of government budgets is but one of many factors affecting the stock market. David Weiss is chief economist at Standard & Poor's. Standard & Poor's is known to investors worldwide as a leader of financial market intelligence and maintains one of the most widely followed indices of large cap American stocks, the S&P 500. Dave, thanks for sitting down with us today.
Thank you.
Lately it seems that the administration and the media have been putting black hats on bankers and pointing fingers as those folks being sort of the source of the housing crisis and the financial mess that we've been through. Curiously, nobody talks much about the rating agencies and the role that they played in terms of the housing crisis, the securitization of mortgages, the re-securitization of mortgages, and that whole subprime meltdown. Do you think the rating agencies should be catching more heat for their role?
Well, we certainly feel we're catching a lot of heat, frankly. I'm not convinced that we're being exempted from this. We don't make quite as attractive a target as the bankers because we don't make as much money as they do. And you have to realize we're not the ones who made the loans. We did rate them, and certainly they haven't performed as well as we expected them to, I think for some good reasons and some bad reasons.
Have the firms change their approach towards this type of security, or is it still?
No, we've revised our models. You have to when this happens. What we expected would happen, the meltdown in housing prices was not a surprise. That was always built into what we call our BBB case. Since 2005, we've been saying that housing was overpriced, that it's overdue for a correction. What we expected was a national repeat of what occurred in Texas in the mid-'80s. It's been much worse than that. And part of that's because legal differences we didn't fully appreciate between Texas and other states. Part of it's because the degree of, well, I'm not supposed to call it fraud, but in mortgage applications was much greater than we thought it was. And partially it's because markets had changed since then and we didn't fully appreciate how that affected the incentive to let your house go.
Okay. Well, let's talk a little bit about housing and the outlook. I mean, what is your view in terms of when this all turns around and corrects itself? When do we get back into balance in the housing sector? When will credit flows be normalized? Because I think that's really going to be the underpinning of a solid, sustainable recovery.
Well, I think the credit flows are available now. Mortgage rates have come down. They're at record lows. This is a great time to take out a mortgage, a 30-year fixed rate especially. I think that we've seen prices come down to levels that are now consistent with income, at least nationally, not in every city, but Nationally, the average home at the peak of the market was trading at 3.4 times household income. That was a record high. We're now down to 2.4 times, which is actually below the historical average. So housing's on the cheap side. And mortgage rates are at record lows. So it's a good time to buy a house if you're buying a house to live in rather than as an investment.
Now, the recovery apparently is underway. We haven't heard the official declaration and probably won't for a few months, but how do you see the recovery playing itself out? There's been a lot of descriptors out there, the alphabet soup, the V, the U, the W, the L. What's your opinion on how we're going to come out of this?
Well, I'm in the U camp.
You're in the U, okay. What part of the U are we in then?
But I think we've hit bottom.
Okay.
We're starting to see the recovery, but it's going to be a half-speed recovery. Because if you look at recent recoveries, they've largely been led by the consumer. Not a shock, the consumer is 70% of the economy. And the consumer just isn't in a position to go out there and live beyond his means like he did after the last couple of recessions. So that's going to keep things slow.
I think you're right. Well, they're such a big part of the economy that if consumption spending is tepid, and there's a lot of reasons to believe that it will be, double-digit unemployment, housing prices, all that wealth is gone. We've recovered some of the stock market wealth, but we're still well below where we were prior to the recession. So without the consumer spending in, that U isn't going to be as sharp, the other side of it, from what you're telling me. So you're more of a broken U, I guess.
People are getting more cautious about borrowing. They're getting more cautious about spending. Banks are getting more cautious about lending. So all of that means you don't have the ability to go out there and borrow money. You don't have the ability to take your saving rate down to zero. You actually have to, old-fashioned, live within your means.
Isn't that a novel idea?
Well, for Americans, it sure is.
What is your opinion in terms of the policies that have been implemented over the course of this crisis and this recession? How effective have they been? We're still talking about jobs policies, trying to stimulate job growth, get unemployment down. Wasn't that what the Recovery Act was supposed to do?
Yeah, it didn't do much of it, though. Partially, I think the Recovery Act was not terribly well formed. We didn't get as much bang for the buck out of it as we should have. Partially because it wasn't the big problem. The big problem was the meltdown in financial markets. And what had to be done was get financial markets operating again. I think that's happened. That's why we're starting to see a recovery. What you did beyond fixing the problem didn't have as much impact. And obviously, I think you're still dealing with the basic headwinds, and the government's ability to counteract those with fiscal policy is somewhat limited. Let's face it, the problem was we weren't living within our means going into this recession. Having the government not living within its means doesn't help the problem in the long run.
Not setting a very good example. One quick question before we go. How would you assess the performance of Ben Bernanke and the Fed in terms of their response to this crisis and recession?
I think Bernanke gets a bit of a bum rap. I think he's done a better job than people give him credit for. The fact that he understood how crises operate, how financial markets operate, how financial panics have occurred in the past in other countries, I think helped a lot in getting out of this. Now, I think the Fed does deserve some of the blame going into the recession, more on the regulatory side than on the monetary policy side, although I do think they kept interest rates too low for too long. But you have to understand, this was a world crisis, not a U.S. crisis. If you blame the Federal Reserve, it just proves that you can't read newspapers that were printed outside the U.S.
One quick one. When will the Fed start raising rates?
I can't see the Fed raising rates until the unemployment rate starts to come down. At the earliest, that's probably late summer, quite probably after the election, given political realities.
Okay. Dave, thanks for joining us.
Thank you.
Consumer confidence is a big factor in growing the stock market and our economy. So we asked investors here at the Money Show Orlando about their level of confidence moving forward.
I think it's going to be a very choppy market. I think it's going to be very volatile. So confidence, I don't know that I have confidence. I think I'm preparing to play a volatile up and down market.
We buy them basic necessities like gas and groceries, but we really need to get out there and support small business by buying their products and services. They are the backbone of our economy, and if they fail, we all fail. So we need to get out there and support them.
I really think that it's the consumer. The bottom line is the consumer, and spending more money is the only way that they're going to really be able to bolster the economy.
Our view, just talking to companies, is that they're beginning to hire, but very cautiously, very slowly, because they're just not sure what's coming down in terms of the final demand.
I am a little scared of investing at this point, but I think it will improve as the year end comes if they get all the regulations taken care of.
The nation's manufacturing firms were growing at a very strong pace at the start of the first quarter. According to a closely followed survey of top executives, the Institute for Supply Management Index rose from 58.4 from 54.9, its highest reading since August of 2004. Coming up, a look at investing in the healthcare sector and just how blue are blue chip stocks. We'll be right back. Hi, we're on the floor here at the Money Show in Orlando, and I'm joined now by Barbara Marson. Barbara is a fund manager with Gabelli Funds. Thanks for being with us today.
Oh, thanks for having me here, Sean.
Tell us a little bit about the funds that you oversee.
Okay, I manage the Gabelli Blue Chip Value Fund, which is primarily invested in larger blue chip companies that have good brands and franchises, and I think that's where value is right now. And I also co-manage the Gabelli Dividend and Income Fund, which I think is a good place for individuals to be.
Well, let's talk a little bit about both. Let's start with the blue chips, because this has been a wild ride over the past year and a half or so. Where have we been, where are we now, and where are we going?
We sure have. I mean, certainly 2009 was a wonderful year in stock markets in the US and anywhere around the world, and also in the bond market. So we recouped a lot of the previous downfall, and now I think we're back to fairly full valuations, because I think we're going to have a fairly mediocre economy for a couple of years. And I think that now is a time for individuals to be investing in blue chips that pay a dividend, have good balance sheets, good cash earnings, so you can get a good little current return, maybe 3, 4, 5% on your investments as we wait for a better market to emerge after a couple of years.
Now, as part of the appeal of the blue chip stocks that are in your fund, their global reach and that they've got footprints in a variety of regions around the globe, does that help drive that value and that dividend flow?
I think it does. You know, talking about companies like Kraft and General Mills and Bristol-Myers and DuPont and Honeywell, these companies are also selling outside the United States. And I know that even in his inaugural address, our president said that was an objective of the United States, to help increase our exports. But these companies can take advantage of the faster growth, as you say, in the emerging markets, and that helps support their dividends and their cash earnings longer term with the good brands and franchises that they've built up over the years.
Good. Well, with these two funds, I'm curious, is there overlap in terms of the holdings? Because I would imagine there are companies that fit the profile of both of those funds.
There is overlap, and certainly, you know, if we could find a really good company that was terrific and had good cash earnings and dividends and brands, then we would like to own it in both. Now, the Dividend and Income Fund has small, mid, and large cap companies and has a lot more companies. The Blue Chip Value Fund is concentrated more in the larger companies and only has 50 to 60 holdings. So that's the main difference there. But the objective is certainly to find good companies that we think will be worth more over the next 1 to 3 years. Good total return companies, but if we can get a current return with a dividend, then we'd like to.
How is the market, in your opinion, and how do you view the policy actions that we've seen implemented and discussed over the course of the financial crisis and this economic recession?
Well, I think we have a pretty good valuation here, because we have this big bounce back, 5.7% GDP in the fourth quarter. Again, we're going to have it in the first quarter. I know we were talking about how a lot of that comes from just the replacement of inventories after we all froze last year. I think that the administration is trying very hard to put a lot of both, you know, programs that have social objectives into place and also programs to help business. And I think the combination of that is helping to freeze businesses, because I think investors and businesses, you know, whatever industry you're in, you want a framework against which to invest, and I think that that's having the effect of putting a freeze on a lot of spending, and I'm hoping that we stop implementing or suggesting a new program every few minutes within maybe 6 months or so, and we start to relax and make business plans and spend again.
I think you're right, and I've been critical of that as well with the administration. I've called it an audacity of scope, trying to do too much too soon, and I think it has imparted this cloud of uncertainty over the economy.
Yes.
However, thank you very much for joining us today. We appreciate you taking time.
Thank you, Sean. Thank you.
Ed Highland joins us now in another part of the Money Show. He's talking about health care.
Yes, indeed, Sean. Healthcare legislation, and possibly how all that may affect your investments. I'm joined now by Jack Towell. Jack has more than 20 years of experience in healthcare, finance, and retail, and is currently the CEO of WellCheck. And first, Jack, thanks for joining us here at the Money Show. Give us an idea of what WellCheck is all about first.
WellCheck is basically bringing convenient care to the mall environment. We're actually operating in Simon Property Malls. They have about 324 malls throughout the country, and we're going to be expanding healthcare into that venue, making it convenient and affordable for most Americans to get convenient access to high quality care.
And part of that was your background was bringing it to big box stores like Walmart.
Yeah, we were actually the first company to actually go out to Walmart and to convince them to go into the convenient care space.
A lot of talk these days about healthcare legislation. Maybe it'll happen, maybe it won't. One of the things that people are looking at is investment opportunities. How do you play that particular game?
Right. Well, we see that there's certain vacuums that have been created in healthcare over the course of the last 20 years or so, one of which is primary care. So many things have actually been set up to make primary care a great investment opportunity, and that's what we're going after. We're going after filling the gap that's been created by the lack of primary care physicians, and using an extender model, using basically nurse practitioners to fill the gap where the primary care doctors are no longer.
Now, it seems like there has been an umbrella of support that is spread out, not necessarily for legislation that's being talked about, but there's been a lot of organizations, for example, that have stepped up. There have been a lot of, as you were just discussing, organizations like yours that are going to the large stores to help people who do not have primary care physicians right now, or insurance for that matter.
Right. Well, one of the things that's moving forward, and you see it in the legislation, is the opening access to primary care and the concept of a medical home. And we believe, significantly that the medical home concept is going to be coming back, in which you have a primary care physician or a primary care extender that is your gatekeeper essentially, and allowing you access basically into the primary care system. From there, then you would go into the specialty systems, and so with that open access, you should have some more of the 45 million people that currently don't have access to healthcare actually have a better access point.
What about the government's role in all this? Obviously, anything that happens or doesn't happen is going to be, there's going to be guidelines. I mean, there's going to be things out there that really may impact how far you can go, what you can do for that matter when it comes to caring for people.
Sure. Well, I think what you're going to find is you're going to have additional people coming into the healthcare system. The government, I can almost guarantee they're going to have some sort of mandate to bring in younger people and healthier people into the system, because without actually expanding the risk pool, it would be impossible to bring down the cost of healthcare to the average individual. So by bringing in the younger groups, the younger, healthier, what they call the young invincibles, you'll be able to spread that risk over so that the rates can actually start going down for some people. So I think you can have a lot of legislation moving in that direction, and I would bet that if nothing goes through on this particular legislation, there's going to be another point on expanding healthcare to the younger groups.
Do you see a pushback or a partnership when it comes to participation by the large insurance type companies?
When it comes to companies like ours, 4 or 5 years ago there was pushback, but they've come to see it as a great alternative. It's needed, as I mentioned. It's a vacuum, and so we're filling that vacuum, and they're starting to get them involved and seeing this as a great access point, lower cost healthcare. The key here is actually reducing the cost of healthcare versus cost containment, which was popular 15 and 20 years ago.
One thing that keeps popping up in the conversations are the comparisons to socialized type medicine in France, more of a Canadian type system. Do you envision us getting that type of an overall coverage, even though it won't be called the same thing?
Yeah, no, I don't see it going towards socialized medicine. I think that the lobbying groups are too strong for that to actually happen. But I think, again, as you expand coverage and have easier access points, it's going to seem that it's more socialized.
Well, Jack Towell of WellCheck, thank you so much for joining us here today on Money Talks America. And we'll have much more from The Money Show when you stay with us right here.
Welcome back to the Money Show in Orlando. Private sector jobs fell by 22,000 in January, the smallest loss since employment began dropping in 2008, and even better than expectations. This all according to the ADP National Employment Report. Non-farm private employment in the service sector actually increased by 38,000, but this was not enough to offset losses elsewhere. U.S. employers announced last month that they plan to lay off over 71,000 workers, the first time since July of last year that planned job cuts have gone up. A big question mark is whether the global economy is in sync with the U.S. recovery. Keith Fitzgerald is Chief Investment Strategist for Money Map Press, with more than 500,000 daily readers in 30 countries around the world. Keith, thanks for joining us. China's economy has been on fire, but there is a concern that when they tap the brakes, the rest of the world may slow down too. What's your take?
Well, you know, in the past, it used to be said that if America catches cold, China's going to have a problem, or the rest of the world's going to catch pneumonia. The situation is very much as you've laid it out. This time around, China has gained so much strength that if it catches cold, the rest of the world is probably going to catch pneumonia. Now, tapping on the brakes is a problem Washington wishes they had. You know, I can't stress how different the two scenarios are. We're playing with monopoly money. They've got $2.3 trillion they've saved up for a rainy day, and now they're spending it. Very, very different scenario. So putting on the brakes is a good thing.
For years, the Chinese have intervened in foreign exchange markets to lower the value of their currency. Do you see that changing anytime soon? And what impact might it have on world economies?
Well, that's an interesting question because, you know, the notion that China's currency is 60% undervalued is probably real. The situation is very tricky though, because you hear a lot of people saying China needs to devalue or revalue its currency, they need to let it float. That's very tough, and you got to be really careful what you wish for, because if China makes 90% of the world's copiers, 90% of the world's toys, blue jeans, pens, fountains, everything you use, if they devalue or they revalue their currency, instantly all of those things in the United States are going to cost double, even triple what they do today. So you've got to be really careful about it. Now, I think China will eventually allow its currency to float. I think that's inevitable. The question is when, and nobody knows the answer to that. That is a very tightly guarded secret in Beijing. I don't think it's one that needs to unduly concern most investors if they properly plan for it. And simply just expect the best, because that's what China's doing. They're expecting the best, and their currency is a very careful way of managing that expectation. Here it's a fear factor.
Do you see the recovery in Europe lagging that of the United States? If so, why?
You know, Europe is sort of the question of the day. You know, it used to be that Europe could be counted on. I think that we're seeing fundamental structural flaws in the EU. I think that the Greek scenario is really only at the earliest stage of a credit bubble that is going to have global implications. I think that the credit crisis in that regard is going to affect Europe for much longer than it affects the United States, if for the sole reason they don't have the production capacity that we do. Now, are there pockets of success? Are there things we can do there? Yes, there are. I think their infrastructure is key. There's lots of places in Europe that belong to the former Soviet Union, for example, that are still really developing in earnest. I think Russia's an interesting play. It's very much still mafia capitalism, so you've got to be very careful what you do over there. But there is tremendous opportunity. Energy, infrastructure, I think banking and finance, once the credit mess gets straightened out, could be very compelling opportunities there. So I'm optimistic, but I'm not ready to pile into Europe yet.
Keith Fitzgerald, thanks for joining us today.
Thank you very much.
We've heard from a number of experts this year at the Money Show in Orlando, and we talked about what the shape of the recovery in the U.S. economy may look like. The shape of the recovery is not going to be like a V. It's going to be more like the tapered spout of the gravy boat. Growth will be slow and tepid in the early parts of this recovery. Consumers represent over 2/3 of the U.S. economy, and if their spending is weak, then economic growth is going to be weak. You might say, well, what about the figures we're getting about the fourth quarter of 2009? They show extremely strong growth in real GDP. But if you look deeper and look behind that number, you see that most of that growth is driven by businesses replenishing inventories that were drawn down during the long recession that we've been through. You might want to think of that fourth quarter GDP number as a lump in the gravy boat recovery. We'll see you next time on Money Talks America. I'm Sean Snaith.